Greetings. I'm Nick Sherman's President and Chief Investment Officer of Pure Portfolios. Today, we're talking about the biggest advisor and investor blind spot out there, understanding risk. Many investors are very in tune with how their portfolio is doing. I'm up 8%, I'm up 10%. What they're not so good at is understanding how much risk they're taking and what's lurking out there. So in this video, I look to unpack the definition of risk, how you can understand and mitigate risk today before something happens, and some easy to understand tools on how we do this for Pure Portfolios and our clients. And this was really spurred on by the recent bout of volatility that we had at the end of July and early August. It really was the first hiccup that we've had in 2024. We started to get a lot of questions worrying about prospects for the market going forward, but also a few client meetings that I had where we were talking about Pure Portfolios risk and performance, and several of these clients had outside assets and were commenting that maybe this portfolio at another advisor had done better. And I asked the client to talk about the risks that they were taking. How much in equities did they have? How much in bonds did they have? Because the assets at Pure were quite conservative. And I was met with blank stares. They really didn't know how much risk they were taking. And upon review of those outside statements, those outside accounts, it turns out they owned anywhere from 90 to 95% equities, all piled into the riskiest corners of the market. So again, that goes back to my earlier comments. We all understand, can easily quote the performance that we've achieved for most of our accounts. Most people don't understand the range of potential outcomes in risk. So we're going to show you how to do that in a easy to understand way. So first, let's define risk. And I think a lot of people believe that risk is stock prices moving up and down and the volatility of the market. Sure, that can make people do dumb things, but that's not actual risk. Risk, in my opinion, and this is from Money Visuals, is a permanent loss of capital. That's what true risk is. You've got money invested, you've invested in real estate, you've invested in some asset, and if you experience a permanent loss of your capital, that's true risk. Okay, so one of my favorite things to do with new investors is to bring up this scenario. So if I asked someone to tell me which portfolio is superior, portfolio A or portfolio B, and the only piece of information that I shared is what the two portfolios achieved in terms of return for the previous year. So let's say 2023, I show you portfolio A, portfolio B, and say, Mr. Investor or Mrs. Investor, pick the superior portfolio. You couldn't. The short answer is you could not if you do not understand the journey, meaning how much risk you're taking, how did those underlying assets move in the year of 2023 to achieve that 8% return, okay? So oftentimes when I unpack this and I share this, this is what I use as an example. And from this graph, anybody can see that portfolio A is much superior given that it's a steady rise to the top. There's not a lot of underlying movement in this line, which would resemble the portfolio. On the other hand, portfolio B is moving crazy. It's moving up, down, these wild swings, probably pretty hard to stick to if you're a conservative investor, especially during some of these difficult times. So portfolio A, from a risk-adjusted standpoint, is superior to portfolio B. So given the same level of return, it's a much more smooth ride versus portfolio B. So A would be a superior portfolio. Now, how do we at Pure Portfolios help potential clients to unpack and understand risk? Risk is one of those things we all know what it is, but in the context of investing in a portfolio, it can be confusing sometimes. People anchor to weird stuff like I'm a 60-40 investor or I'm a balanced investor, but you truly don't understand the range of potential outcomes. So one thing that we really hammer on is range of outcomes. So basically what this is a range of potential outcomes based on a portfolio. And this is just a hypothetical. We added a bunch of holdings and you can see the portfolio is roughly 46% stocks, 22% bonds, some alternative investments like private equity and hedge funds. We've loaded all these into our tool, and through our tool, we can basically assign a risk and return profile to every single asset in the portfolio and come up with a range of potential outcomes based on how someone is invested. So for this particular portfolio, we can say with confidence, with 95% confidence, the range of outcomes for this portfolio based on 1.3 million is minus 12% or minus 163,000 or plus 18% plus 246,000 over the next 6 months. Okay, a lot of people scratch their head when I show them 6 months because we're all conditioned to be long-term investors. However, we found it's really hard for someone to stick to their long-term investment plan if they don't understand the range of outcomes in the short term. So this is tangible. We're using dollars and percent. We're bringing risk to life. And this includes 95% of all potential outcomes. That leaves 5% of outliers, as we call them, or very weird events. Some people say black swan. So how do they account for those? Again, same portfolio. We're running all the holdings through this tool, and we're stress testing the portfolio to show if the inflation crash of 2022 happened again, how would your portfolio act? And we throw a couple benchmarks in there just for context. So we've got the range of potential outcomes during normal times. We stress test every prospective client portfolio, and show this to people because this is real. It's tangible. Dollars make sense. Percent makes sense rather than anchoring to a 60-40 bias or a balanced bias. All right, this is my favorite thing to show during client meetings, especially after we've gotten a difficult market or just through a difficult market environment. So what this is a drawdown. There's a lot of different ways to show risk. This is the most simple. This is also my favorite. So 2024 has been quite calm other than the end of July and the early part of August. So this blue line is the S&P 500. This yellow line is the MSCI EAFE index, which is just a foreign stock index. The red is the Dow Jones, and the green is our sample client portfolio. Light blue is a bond index. We'll ignore that for now. So what I want to understand as a professional investor, when the S&P is down by over 8% in a week, how does my portfolio act? And again, our sample client portfolio is this green here, okay? So when the S&P is down almost 9% in a period of a week, I want to understand the drawdown for the green portfolio. If there's a gap here, a gap between the blue and the green line, that's good. That's diversification working. That shows the gold, the Bitcoin, the other equity asset classes in which we own do well to mitigate downside risk. What would be bad is if our diversified portfolio was participating in the downside the same as a 100% equity portfolio. So this is something that we show every client, not only the range of outcomes based on how they're invested, but drawdown in the context of if the S&P is down 10%, if the S&P is down 20%, I want to understand how your portfolio acts. So if you're working with an advisor, if you're working with multiple advisors and you don't know how much risk you're taking, if you're a do-it-yourself investor and you don't know how much risk that you're taking, good investing starts today. It's not we wait for a market correction and then make a bunch of changes. We want to build portfolios that we not only understand risk, but that portfolio reflects the way that you feel about risk in your financial plan. So if you have any questions, shoot us a note at insight@pureportfolios.com. We'll take a look at your portfolio for free and get you pointed in the right direction before the next market event happens. Thanks. We'll see you next time.